a couple of really, really cool people. We have Marcus Benitez, is the head of sales for Copper in Switzerland, and a really nice guy as well. So very glad to have you. We have Balder Bomans, managing partner of Maven 11. We have Sidney Powell, the CEO and co-founder of Maple Finance and portfolio company of Blockcelerate, I think. And last but not least, Stani Kulechov. Stani is the pioneer, of course, as you probably all know, in the DeFi space. Yes, he's behind Avara, and he is now the founder and CEO of the Avara Group. Thank you very much, and come on board, please.
Let's talk about lending. It's pretty big business in traditional finance, but in crypto, it's been responsible for so many nightmares over the last 2 years. I think all of you here remember names like BlockFi, Celsius, Voyager, and a lot of trading desks that were lending desks that were issuing debt that maybe didn't do the world's best job of it. And as a consequence, we've seen blaring headlines in the Wall Street Journal and the Financial Times and even the New York Times. We've seen congressional investigations. We've seen a lot of red on CoinMarketCap as a consequence. But lending's important, right? Lending is critical for any sort of financial industry to work, even the next generation finance. And I know some of you are founding or investing in the companies that are building next generation lenders that maybe don't have all the flaws of the organizations I just named. So I want to talk a little bit about lending. Why don't we start with you, Stani? Why did you start Aave in the first place? I want to have an understanding kind of DeFi before we start talking about kind of CDFi.
Yeah, I mean, I kind of like started programming very early and building web applications when I was 13, 14, and did it for a few years, and mainly kind of like a social applications where Reddit and Slashdot and Dig and those kind of communities started to emerge. And I got a little bit later, I think it was in high school, I got excited about fintech. And I think that was where a lot of the kind of like a peer-to-peer lending stuff started to kick off a bit, and crowdfunding and all these interesting ways of like where you can contribute to capital as a kind of normie over the internet. And at some point, a little bit later, I went to college, and there I started to get more excited about like what could be done in building, global, accessible financial applications. And I stumbled upon Ethereum and also kind of like the potential that you could do where you have like a programmable machine running on the internet, and you can create applications and deploy them, and they run autonomously. And I basically wanted to create a similar idea of what already existed like in more traditional finance. So when you have certain value, certain assets, you could unlock some of the liquidity of those assets. Yeah, and so
use them as collateral.
Exactly, and you can borrow against. And all these discussions about BlockFi and centralized lenders they really resonate for me, because I approached from the smart contract perspective and building a protocol. But at that time, when I was just starting up, I was also considering building just a lending business and effectively doing it a little bit more centralized. So the same way as what later, BlockFi and Celsius and all the likes were doing.
So why didn't you?
I was too much excited about what was happening on Ethereum and what the technology actually could do. And that was interesting because I saw the following 2 years where all these centralized lending platforms were growing into multi-billion-dollar businesses, while DeFi was like still in existence.
So, all right, let's tap into that later. Let's talk about the rise of these giants, because indeed they became huge overnight. Sid, why? Why did they get so big in the first place? Because then I want to talk about kind of why they collapsed.
It's a good question. I think it's a multi-factor answer. So if you look at where a lot of the deposit bases came from, so Celsius, BlockFi typically had maybe more of a retail depositor base. And so the customer acquisition strategy was to pay out yield on those deposits.
Huge yields.
Large yields, and that could be partially funded by tokens, as in the case of like the Cell token, or it could just be funded, maybe via equity reserves. So you're actually paying out more than what you earn on interest to these depositors. But broadly, it was that paid customer acquisition strategy. And then I think it was also a byproduct of so much funding coming into the space. So these companies are all doing successive multi-$100 million rounds every, at least every 12 months. And so you had this, that allowed them to grow the lending book like super quickly. So Celsius at its height got to about 26 billion in assets under management. And it was this reinforcing cycle. So as crypto prices increased, people wanted to deposit more because you want to get a higher yield on your appreciating assets. And that cycle, built until it was unsustainable. And at that point, you had losses emerge because eventually every credit cycle, whether it happens in DeFi or in traditional finance, ends up the same way, which is credit standards decline, loans are put out that shouldn't be, and then you have losses, and that's when the feedback goes in reverse.
So let's talk a little bit about kind of the underwriting process and how that's kind of changed over time. Balder, at Maven 11, you have an underwriting team, in fact, that does some of the diligence on non-collateralized lending, for example. Have you seen as an investor and as someone who's kind of running a business in the side that standards decreased? And how have things changed since the blow-ups with BlockFi, Celsius, et cetera?
Yeah, massively, obviously. I think it's important also to note the backdrop for the resurgence of Celsius and BlockFi at the time was obviously an interest rate environment with 0%. So it was extreme amount of competitiveness between BlockFi and Celsius to get the clients to them. They were offering higher yields on an ongoing basis. And they need to get the money to work. So they need to get the money to all the market makers, make sure they get yield in the back end to pay their clients. And that's definitely when we saw a lot of, I think credit standards at large were not good enough. So we saw that at large happening. And then what happened, I think the credit standards went down and it went worse and worse from there.
Yeah, I mean, we certainly saw that, for example, there were certain hedge funds that were taking out loans from just about everybody, right, Marcos? It seemed like one called 3AC was taking out loans for everyone, and then when they were eventually asked to pay those back, they didn't have the means to do so, especially with the collapse of certain types of assets like Terra Luna. Yes. Have things changed? And as a custodian, for example, you guys are holding on to a lot of the money. Have things changed, and have you seen that at Copper? Yeah, definitely. I think it was mainly driven the last cycle by greed and price. No, prices go up, and then everyone gets excited. They start missing ticking boxes. And that's when the issues start. It's like just a house of cards, no? I think what we saw with Terra Luna, then this triggered, the collapse of many players. And sorry for my French, but it was like mainly like a circle jerk, between in a fractional banking that was created because of that greed. And then we have to push the yields higher because we need to pay back to the investors or the retail, depositing their assets. What we see, I mean, to be honest, Copper was not really involved in these activities in the previous cycle. We are now going into that. But what we see is that definitely by participating, collaborating with some other parties, we see definitely more maturity and that people is starting, to tick the boxes. And for example, we see third parties which are like matchmaking platforms, which onboard both parties, lender and borrowers, and they ask, okay, show me what you got. Show me what is your risk framework? How is your balance sheet looking like? And that's, I think, definitely is changing. So I actually want to ask you.
I was just going to say it's worth noting. So for some of these hedge fund borrowers, it was kind of a game because there was because there was an abundance of capital. They had multiple different lenders that they could choose from, and so they go to one and they'd say, "We'd like $200 million loan." And then you'd ask for financials, or you'd be negotiating price, and then they'd say, "Well, we're going to go to this one, and they will do this without requiring full financials from us or audited financials." And so, partly that's a structural issue where it can be driven by just the abundance of capital because everyone had to put their capital to work. But it led to instances where you saw, 3AC at one point had multiple billions outstanding, and that was largely, the extent of the due diligence was just a self-attestation that they had X billion dollars of net assets.
So how are we preventing this today?
So I think monitoring is probably key. You can have management accounts, which lets you see the state of the business on a month-to-month basis. One of the issues was that even with that, you might not see how their trading positions in equity could change week to week. And so more active monitoring is one of the tools that I think will help lower or mitigate this risk. So you can see if 3AC, for example, were saying that they were delta neutral, but now they're actually massively long, ETH or BTC, which was ultimately what happened to them. They went from being neutral to very long, and the trade went against them.
Okay, so actually, I think we need
to add to that, I think also the market healed itself.
Yeah.
So there was an abundance of capital today.
I think we need to back up just a moment, actually. Yeah. So first, what are the criteria, I should say, for who the borrowers are? I think that's changed over time, right? To your point, earlier there might have been a huge retail drive because interest rates were at zero and many people had made money on Bitcoin or Ether and they wanted their capital to work. Things have changed today, is that correct? The people who are borrowing via Maple, for example, those are a different profile than the people who were borrowing in the past. And I want to understand Ave's user base as well.
Yeah, the profile in Maple's early days was largely market neutral trading firms. I think that will actually come back this year because if you look at trading volumes are increasing, so those are becoming more profitable, but it shifted and became real world asset businesses, so fintech originators, as well as funds who are posting collateral. So the profile of the lender changed. One other thing I was just going to add, though, is that you're seeing now more use of escrow and clearinghouse to kind of warehouse the risk and make sure that collateral is being held and that, the asset balances of the borrowers are good.
Yeah,
okay.
Happy to add to that later.
Yeah, so which is exactly what Copper is doing.
Well, so how is Copper contributing?
Well, essentially, so we start discussing, with our clients, which are, mainly, hedge funds, market makers, foundations. So we have both sides, cash-rich clients and clients which need this liquidity to trade. So one of the solutions was Clearloop, which is, essentially off-exchange settlement that allows you to trade on an exchange without moving the capital to the exchange. And we thought, okay, why don't we get the cash from the cash-rich clients? We lend it to the borrowers, and they're going to be just secluded to use that capital within these parameters. The parameters are essentially you can trade as much as you want, but only on Clearloop exchanges. And we give then the lenders a possibility to monitor that risk. So essentially, it's going back to what happened before. It's like if you don't know where the yield comes, you are the yield, and we are trying to solve that dilemma now by letting the lenders know, okay, how my capital is being utilized, and I have some sort of control.
So there's better active information.
Transparency.
That's one of the things that's changed seemingly since the disaster of 2022. Is that correct?
More information and segregation of responsibilities.
Yeah.
Is this mirroring TradFi in some way?
To some extent, yes. So, the use of what Copper is doing is similar to a clearinghouse. If you're doing, say, commodities lending, you might have a third party who actually holds if you're lending against grain or a precious metal or something, you might have a third party who holds that and then sells it or liquidates it. And this is the same function that smart contracts in DeFi lending do. So with Aave, with Maker, Spark, Compound, the smart contract acts in a similar way. But I think as well with information, having the ability to kind of see positions and risk day to day is crucially important. And the infrastructure didn't exist there going back 2 years ago. Whereas now you have off-exchange settlement, which means you're actually not even any longer taking the exchange risk because the assets sit in a trust and then they are mirrored on Binance or Deribit or Bybit. So in that situation, you would no longer have the FTX style risk, which is where we might have lent to a trading firm who was actually good and they were performing, but they lost assets on FTX. And
through rehypothecation that FTX was doing.
Yes.
Illicit.
Yeah. So suddenly they might have $50 million on FTX that they can't actually access to pay back our loan.
One thing we saw, and this was kind of interesting, is that as we saw a huge breakdown with the centralized lenders, we didn't really see that in DeFi. It looked like this was DeFi's kind of shining moment, was it not? Because we didn't see the same types of blowups.
Yeah, why wouldn't you? Basically, the idea of decentralized finance is basically change the infrastructure of traditional finance. So, for example, instead of creating these loan agreements, behind of closed doors, the point of DeFi is that you have a kind of like a playing ground. Like imagine like a football game that everyone sees what's happening and who's passing the ball and who's playing there, and you see all this exposure to everything. And that transparency is something that helps not only to manage risk, for example, and that's something that happens in the Aave ecosystem. So we as a team, we simply build software, but then in the Aave DAO, there's contributors that are such as Gauntlet, Chaos Labs, that are actually managing the risk. But those are just service providers. The beauty of the system is that any one of us could actually go and create proposals and contribute to the risk. And when we look at the centralized lending providers or anything that is off-chain and we don't have visibility, they're gonna be the next BlockFi and the next Celsius, because I think the power in the system is that with DeFi, we change the infrastructure into a transparent, basically, loan book, and also smart contract-based execution, so you can actually do this and scale this in a borderless way. So you can have counterparties that are in Asia, in the Western world, and globally. And I think like what DeFi is basically trying to do is change the way we actually do business in the future, like not just finance, but pretty much everything.
But are there advantages to centralized lending that don't exist?
I don't think so, because like the thing about DeFi is that people say that decentralization has a cost associated into it, and I think it's true, but it's true for now. For example, if you have better observation and transparency of the markets, and you have guaranteed execution, what actually happens in the future is that it becomes less riskier for you, or you can calculate your risk more accurately, meaning that if DeFi is the place where you can quantify the risk more accurately, it means it's a better environment compared to, let's say, the traditional ways.
Because you could theoretically offer better pricing, is that correct? Because there still seems to be a place.
Risk, I think, the risk management.
Yeah, so is there still a place for centralized lenders?
Yes.
I will argue that actually there is, and it's essentially your fiduciary duty as an institutional, that maybe you cannot face for the time being, a counterparty like Aave, Compound, and so on. And then you need to go and then see, okay, who is my counterparty? I need to know it. I need to know that this is OFAC sanctions compliant, KYC, and so on. And I think that's for now, the role that we are fulfilling. We are taking some of those tools, that you have on the decentralized finance and replicating it on a more, let's say, TradFi friendly way. But definitely, we also allow our clients via, some connectivity to participate in Aave. But that's more like, okay, if you want to take that risk, you're fine with it, according to your policies. Go ahead, of course, but there are people who cannot do it.
So not every TradFi player can do that, is that right?
Exactly.
Balder?
Yeah, of course not. It's a very particular industry, right? There's a lot of, we discussed the counterparty risk of the exchanges just now. We had a stablecoin risk this year. So there's a lot of risk included, which I think you need to include in your assessment. And I think from that perspective, it needs to make sense. So it's the also discussion around centralized lenders. Obviously, what Stani has built is obviously a platform which is completely over-collateralized, but credit creation is important, and I think that's where a lot of knowledge needs to come into the space.
Let's double tap into that. I want to talk a little bit about credit, because that, to your point, that's how markets get gigantic. But sorry, did you have a comment?
I was just going to add, I think there's still a place for a specialized underwriting for situations where you might have an illiquid asset. We sort of saw this play out actually in DeFi over the last 6 months with the Curve founder loans. So that was effectively specialized underwriting came in and said, hold on, this is not really a liquid asset after the loans have been originated. And then there was a process of risk management where people tried to downsize those exposures.
That's an interesting point, what you said, because the Curve example is really good because you kind of see all these like different DAOs, and not every DeFi project is actually a DAO. There's might be like a multi-sig and bunch of founders managing it. But effectively, what's interesting about this DeFi communities is that they have their own risk appetite. So for example, it became kind of obvious in the Aave ecosystem that, for example, these CRV positions are something that isn't wanted there, and it was running in the old version of the v2. And down the line, the community took measures. There was proposals for Chaos, Gauntlet, and various community members to get rid of this exposure. And now you actually see the same positions actually going from the previous protocols into the other DeFi protocols. So you kind of see that there's different DeFi communities that actually are maybe more risk tolerant. So like all DeFi is not equal in the same way, but that's a good thing because it brings also different risk categories and appetites. But it's something that's interesting to navigate down the line, because especially if you are like institutional player or participating in DeFi, like what is the right risk tolerance there?
So now that we've seen kind of the blow-ups of these giants, is a new dominant player going to emerge? Is it going to be JP Morgan on DeFi? Is it going to be a crypto native organization? Who are we going to see emerge as a winner in the near term?
I think no one. I think the point is DeFi is when you get too big, people start to scream and complain, and and then
This is the retail market. That's who complains,
and
right?
you have some sort of vampire attack or something, and people try to divide the market. I think that's the beauty also like with open source and decentralized software is that like if you don't like what exists, you can really quickly spin up a new community and do things in a different way. But surely on an experience level and risk management level, there probably will be someone who gets a lot of things right and grows a lot.
Yeah, Sid?
One of the challenges with lending, which it has in common with insurance, is that you can be the dominant player in an industry, but as you go through a cycle, you can actually come out and your business can be totally impaired in a matter of months. So if you look at Deutsche Bank, Citigroup, any number of these TradFi institutions who went through the 2008-2009 cycle, the ones who were number one, suffered in a lot of cases the largest losses. You have a new dominant player now, which is JP Morgan, but you haven't actually seen a player be consistently dominant in banking or lending for a multi-decade period, because like insurance, it takes a long time to know if you've actually written profitable business, and it can be multiple years before you realize if that loan actually delivered a return, or if it was actually something that ended up putting losses on your book.
I will add that maybe what the role has been filled so far by exchanges, after all the collapses. And definitely because of the segregation of duties, that is going to be more and more a topic, not only on custody, but also, okay, how do you generate yield for your clients, pooling assets and so on. Probably that's gonna decrease from the centralized exchanges, the big players like Binance and so on, where you can get a yield, right? Still nowadays.
We've seen some of this, for example, regulators who do not let exchanges offer yield products, right?
Or staking, for example, pool staking. Yeah.
And I think to that question, and besides, is there going to be one winner, if it's the brand or CFI, DeFi, I think definitely the takeaway is that majority of the volume will be on-chain, right? Avara survived in a great way the crash. Platforms like Maple Finance offer a lot of transparency and accountability to their end clients, either being institutions or maybe retail again in the future. So I think the majority of the issued loans on being over-collateralized and under-collateralized or unsecured will be on-chain in the future.
Do we think the profile of borrowers and lenders is going to change in 2024? We just saw the Bitcoin ETF approved, right? It seems like there's going to be a rush of new retail into the space. People's retirement accounts means that they're going to have Bitcoin exposure. And historically, you've seen if you have Bitcoin, eventually you buy Ether. Once you buy Ether, you might try DeFi, just kind of the nature of how it works. Are we going to see a rush of new borrowers in 2024?
I think, at least from where we're sitting,
yeah.
I think it's great that the counterparties, the hedge funds, the market makers, the arbitrage firms you're speaking to today, they survived the crash. So it gives them again another, I think, tick in the box. They've been around for 4 or 5 years.
So these are kind of the crypto institutionals, the market makers who,
the GSR, the Intimutes, the flow traders, etc. Right? So they've survived that phase. They're strong, well financed generally. So they will be here to stay, and I think there's going to be a lot of new outfits also who did very well, and they're going to be also asking for credit in the future. So I think a lot of different players are definitely coming back in the market for unsecured lending. Yeah.
My take will be that there is better infrastructure, your protocol, and then you have people like Celeste, which is a matchmaking platform. arranging the loans, and this will bring a bit of transparency and more comfort to certain players. So we probably will starting to see maybe a shift from some TradFi players that want to tip the toes in the crypto ecosystem or digital assets in general. No,
It seems like a new market for many of them, right? New way for them to get exposure to, on both sides of the book, I should say.
yeah.
I think two interesting observations. So I think exchanges are kind of the largest shadow lender that they don't report lending balances at the moment, but they're the ones making the largest loan originations at the moment, which is going to market makers because they make what they don't charge on interest, they make back on trading fees. But I think if 2023 was like the narrative was real world assets, I think 2024 will be crypto native institutions. So you'll see more market makers, more funds borrowing because price appreciation and trading activity drives this. And then I think you'll see eventually, like if we kind of fast forward in the cycle, you'll see some TradFi firms kind of come in, and then 2025, I think you'll see more real world assets again. But I think in the meantime, just because of where we are in the new kind of bull cycle, you'll see a lot more lending and borrowing done by the crypto native firms again.
I want to find out, or want to ask, I should say, what infrastructure is missing for a regular person, average Joe, to be taking advantage of rates, maybe better pricing from DeFi? Because right now, if I'm as an average Joe, it's pretty easy for me to go and approach a fintech and take out a personal non-secured loan, right? It's pretty easy to do. I use my credit score. What needs to happen for there to be an additional connection to the world of DeFi, where DeFi can be contributing to better, let's call it better priced personal loans? What's missing?
I would say
Stani?
like distribution is one thing. I mean, DeFi as an infrastructure is there, but it's also really like nascent still. I mean, DeFi has been probably running for a few years now, and some of these protocols are quite big, but also like, I still think there's a little bit of that immaturity there to scale to like all the users. I think there's still innovation that should happen in between, but effectively like scaling the existing offerings to average people. I think it's a question of distribution because people who actually want to access into those yields, they will find. I don't know like what's more challenging today, basically to set up a wallet and fund it. Versus basically onboarding into a bank and filling a lot of KYC and whatnot. So like there's equally UX challenges, and same with getting onto internet, in the past decades, like it became more like easier and easier. And I think it's obviously the UX will get better and we'll see more distribution. Maybe fintechs are looking into this area a bit more and providing access, but also like they need some clarity, like where does DeFi sit? Is it, is this permissionless? Is this like Bitcoin, for example, or is this something where they have to figure out the regulation part? And some institutions have. I mean, there are banks in Switzerland, CBI and Amina, they renamed, and Sidney has been doing an amazing job on plugging in DeFi into everything that they're doing. And I think it's more of a distribution thing.
But I would say there, adding on that, banks, but they still have this entry level that you need to come with big pockets to participate, right? So you probably, as such profile, you can deal with the complexity of such a tool, no? As DeFi. Maybe you need an aggregator, right? That will allow you to just in some simple steps, just making a wire from your normal bank account to this provider, and then they will say, okay, we are getting the yield like this. We are using it for maybe to lend to Aave. We're gonna make a markup on that, and we're gonna give you X percent. But I think for that we still have the regulatory framework, which is not there yet, and may not be as comfortable in allowing the retail clients to get into that on tap.
Well, I want to talk about a different type of lending and borrowing, which is, let's call it corporate debt, for example. We haven't seen a whole lot of that in the DeFi/crypto lending ecosystem. Are we going to see a convergence of that in 2024? Sid?
I think we could. I mean, if you look at most of what Maple was doing in 2022 was a form of corporate debt, very short-term working capital, but it was institutional borrowers. Some of them, their equity ranged from between, 1 to 500 million. If that
Equity value of the firm.
Equity value of the firm. So if that firm were borrowing from a bank, that would be classified as corporate debt. But
those are SMEs.
It was only going to one major sector, which was trading firms. And I think what I'd like to see is more diversity. So you might have it go to a media, like the type of companies I've thought of who could borrow corporate debt in crypto would be media companies and PR firms who often invoice their clients in USDC or other stable coins. Law firms will also issue invoices in stable coins, and they have a fairly regular client base that's actually, kind of counter-cyclical. You spend more on legal fees in downturns. And then the other one was smart contract audit firms. So you have, if you've ever done an audit with, a firm like a Spearbit or one of these other, TrailerBits, one of these leading firms, those cost you, sometimes between 1 to 300K per audit, and that's often paid in stablecoins. So that's another one where you could do corporate loans to these firms, and it just smooths out the cash flows for them. They're often paying a lot to like highly paid professionals, and that's what I would like to see and what I'd like to do in 2024.
It sounds like a realistic first step before we start seeing, I'm going to call them, a much wider range of participants, perhaps in 2025 and beyond.
Yeah.
And I like that, and plus basically DAOs, because some of these DAOs are, cash positive, so that they get fees. Avara is an example where...
You mean as lenders?
Borrowers, actually.
As borrowers,
Yeah,
okay.
so the Avara gets revenue from the ongoing activity and sets off some of the costs like security audits and development cost, and then there's a surplus. So they could basically take a loan for if they want to build something. But DAOs are still really, really nascent as well as a kind of like a customer. There's still a lot of challenges there, but it's interesting already to see that some of these DAOs are becoming like very very well operated.
Last question, we don't have that much time left. The interest rate environment this year, yesterday we heard a lot of conversation about macro, but it's expected, along with all the elections that are going to take place this year, but the interest rates are going to be flat or lower in most economies around the world. How is that going to change the state of lending in crypto?
Yeah,
Marcos?
There's a huge impact because you have a higher demand, for lending and borrowing when the interest overpass, whatever you get by almost zero risk that you have versus the U.S. Treasury, So it incentivizes the liquidity, the volatility, and then all these players want more. They want cheap capital or at the lowest rate possible, but you are incentivized to lend because you're going to get more than just having an account at Interactive Brokers, so to say.
Balder, how are you? For your portfolio companies? What are you advising them in this market environment?
I think it's going to be a great market environment for crypto as a whole this year. And in terms of the lending side of things, I think it's all driven by activity, like Sid just said, right? We see a lot more hedge funds being active, a lot more institutional capital, obviously. Arbitrage firms are playing around with the volatility, and I think that will drive demand for loans. And I think if you see the market today, there's still a lot of demand at 8-9%, but when rates are going down and we can offer 12% loans to high-quality market makers or firms, I think that's definitely going to drive demand on the lending side.
So do you think rates are going to change here, or prices, I should say?
So I agree with your statement that from a macro perspective, rates will come in a bit. I think what we're seeing is that crypto rates have kind of held steady. Secured rates are about 8 to 11%. Unsecured rates are probably 13 to 16, 17%. So it's still like, if you look back in 2022, it was about a 10% premium to treasuries. It's still about a 10% premium to treasuries to borrow unsecured. And so I think that rate environment is going to be beneficial for lending.
All right, well, I'm looking forward to getting an update on all of this next year at CfC. Gentlemen, thank you so much.
Thank you so much.
Thank you.